Yes, the economy's slowing. Yes, there's $1 trillion in credit card debt. Yes, there's a lot of things going on, but no, we are not going to have a housing market collapse or a stock market crash. Stick around and I'll get into the details why. Good morning. My name is Adam Kahn and I'm the Rational Investor. Today is Friday, October 27th, and I hope you're all enjoying your Friday and have some fun plans for the weekend. Before I get into all the reasons why we're not going to have a housing collapse or a stock market collapse, do me a favor, hit that subscribe button, hit the like button, make some comments, let me know why I'm wrong. I know a lot of you out there totally disagree with me. It's totally cool. I'll be happy to discuss it as I really love this stuff. I'm also going to put a link in the description, probably two, on how to open an account at SoFi. I use them as well. If you put in more than $10, they'll give you a $25 bonus. They even have some advertisements for some other things they give you. And if you do, it gives an account that I opened for my son a little bonus as well. We really appreciate that, and I love the support. I think it's really kind of you guys to be involved like that. So let's start with the $1 trillion of credit card debt that I mentioned originally. So, yeah, absolutely. There's $1 trillion worth of credit card debt, a little bit more. It's more than ever. But of course, there is. I mean, it's really simple to understand that as prices have gone up with the inflation over the past couple of years, if your balance was $100, well, we've had some inflation. It's probably now 140 or 150. And you multiply that across the board for the whole country, of course we're going to have the highest debt ever. Like, it's just natural and it makes sense. The only issue with it is that the interest rates have pushed up. So if you're making minimum payments and you're not that person who's paying off your cards, well, that's going to squeeze you as you're going to watch your minimum payments go up significantly. And maybe that slows you down in other aspects. Does that actually mean the economy is going to collapse? I don't think so. I don't think that means everybody defaults on their credit cards. I think you're going to have people that'll stretch too far, like you typically do. They're going to run into trouble and they're going to have to change their ways or possibly downsize or whatever it is, maybe even claim bankruptcy or whatever. But I don't see that as an entire economic collapse. I just see that as the normal ebb and flow of a society. The economy is slowing down. That's number two. Well, that's what the Fed's been trying to do. So I think that's actually a good thing. And I don't see it coming to a screeching halt. I see it doing exactly what they were hoping. In fact, the last speech that I saw from Jerome Powell seemed really optimistic that he's seeing the things he's hoping for. Because I was a little bit worried that they were disengaged and going to go too far. And I think they pushed the short term rates up as quickly as they could. Now they're selling off their balance sheet, which is causing the 10-year and the 30-year to go the other way because they're selling mortgage backed securities and nobody wants the other side of that, which is stretching out the margins. The reality is, though, if they go too far and they really stop the housing market, if we start to have a real crash and not just a correction, of course they'll reverse and they'll stop it because the banks don't want to own real estate. They've already made that real clear. And they have things in place like forbearance and loan modifications and stuff that they've learned in the past to help make sure that they don't become landlords, because that is not their goal. At least in Las Vegas, the housing market often slows down this time of year. So I think people are overreacting to it. We've seen some softening in prices as well, which I think is just fine. And that's kind of my point. I think if come February or March, if it isn't catching itself on its own, it continues to decline, you'll see the Fed actually reverse course because they don't want to see the market collapse. They'd like a correction. And even if it's 20%, which would feel huge to those of us who own properties, the reality is that's nothing in the scheme of life. That's nothing in terms of the government or a concern that they have. That's just a natural ebb and flow of markets that they'd be perfectly fine with. However, if it doesn't catch itself and you see a ton of inventory start to come to the market, yeah, you'll see the Fed reverse quickly and cut rates and everything else so that mortgage rates go down. And more importantly, they'll stop being a seller of bonds and they'll start buying them again to support the economy. I want you to think for a minute while those of you are all hoping to see this big crash. If the market fell 40%, think of whatever home you're thinking about and imagine that price 40% lower. And the Fed cut rates to where mortgages were back down around 5-6%. Do you really think that house is going to be on the market very long? Or do you think there's enough demand out there and enough money floating around that people are going to gobble it up as quickly as they can? That's why I don't see it being the same as 2008. Is the demand is real, we would need huge unemployment, because I even say that's still the case, even if unemployment ticked up higher than they expected and we got to like 7 or 8% unemployment. I just don't see a 50, 60, 70% correction, people panicked the same way, the housing correcting the same way. I know there's an uptick in foreclosures. I know the delinquencies are falling behind. I really think that's the natural ebb and flow of a market that people want to see. It's what the government was looking for, and it's actually a good, natural, healthy thing. So maybe because interest rates have gone so high, we'll see a big correction. Well, they've been high for a while. We haven't seen the housing market collapse, and we aren't seeing the stock market collapse. Part of that is the well-funded companies. You take an Apple that has a lot of cash on the sidelines, them included, they're able to take advantage of the higher interest rates. It doesn't hurt them. Now, if you're a company that's been borrowing too much and you're highly leveraged, leverage kills everything, whether you're a company or an individual. So any company that's highly leveraged, of course, they're going to run into issues as that matures and turns into something they have to reevaluate. But currently, it seems like the big companies are doing just fine and they're chugging along. They're using this as an opportunity to kind of dwindle down their staff and tighten up their belt and make more money that way. But I don't see them as losing a bunch of money. I see the cash on the sidelines that they have now being able to get some real return. So I don't think the higher interest rates are really hurting them. And if we go back to the housing market, every time it pushes to a new high, it slows it down. And then as it drifts back down a little bit, things seem to pick up. I do think the Fed is selling off their balance sheet. And if they can be able to continue to do that without the housing market collapsing, they'll continue to sell it off. And maybe we will see higher interest rates. If the housing market starts to really collapse or correct itself, they'll stop and they'll become a buyer again and they'll support the market. Now let's talk about prices have gone up too much and everything's unaffordable. Well, are you still working? Are you still keeping up with your bills? As much as we're all complaining and as much as we all don't like it, we've all adjusted and cut back on things to make sure we can afford our lives. Sure, we can't go on that extra vacation or we can't buy that fancy car or whatever it is that we liked doing before. But if we're still working and we're still making a living and we're paying our bills, that's what the slowdown is and what the goal of the Fed was from the beginning. That is not an economy collapse. I see a lot of these other channels that talk about the collapse coming and a bunch of people in the comments kind of rooting it on. And what I really think is it's one of two people. Either it's a person who can't afford the house to begin with, and they just like to see everybody else go through a bad situation, and forgive me, it's pretty sad if you root for everybody else to do poorly. Or two, it's somebody who's hopeful that they'll get into a position because it'll come so cheap that now they can afford a home. There's always demand, and that tends to push markets wherever it pushes it. If the jobs stay there and people continue to work and they continue to be in the position where they can buy homes, it's just not going to collapse where you're going to get the bargains like you did in 2008. The world was really scary that back then. People lost jobs. Nobody was working. People couldn't qualify for anything. And there were too many homes coming to the market. I don't see the government, the banks, or anybody. Look at what happened during COVID. I mean, they came to the rescue really quickly when they were worried about all that stuff. There will be solutions if it starts to turn. And to be perfectly honest, most people I know are complaining about the inflation, but they seem okay. So I just don't see a collapse. Anyway, again, before I forget, thumbs up, like, subscribe. Tell me where I'm wrong. I'm happy to discuss it, and have a great day.